Well, hello, everyone. We have an exciting guest to interview today. This is Vuk from, I think, a company is Oraclum, and we came across his profile on Twitter based on some really neat macroeconomic analysis and threads that Matt actually brought to my attention. And Matt, how did you come across Vuk's thread originally?
I'm not sure actually. Somebody who I follow must have retweeted one of your things, and I just started diving into it. And I thought you had a really kind of level-headed take on some of the macroeconomic trends that are going on right now. So I'm sure we'll get into that in just a minute. But maybe to start, Vuk,
Yeah.
if you wouldn't mind, just give a bit of background about yourself and the company that you founded. You got some really interesting things that you're doing. So there's a lot of different things I'd like to talk to you about. But let's just start at a high level. Some of your background.
Sure. Thanks, guys. Thanks for inviting me, first of all. I'm really happy to be in the show. Yeah, so the bit of background. So I am an economist by vocation. I'm also an entrepreneur. I have a company, as you mentioned, Oracle. I have actually two companies in London, both kind of doing data science sort of stuff. One is more high profile, and this is Oracle. What we're famous for is we designed this new prediction method of kind of improving the way we do polling, essentially, right? This is how we first started it. But maybe I should give you a bit of background before before jumping into work on
Sure.
things. So yeah, I'm from Croatia originally. I did my undergrad here in Zagreb in economics, and then I went to LSE, studied political economics there as well, and then for my master's, and then I finished my PhD at Oxford. In the meantime, I was teaching a bit of econ, started a family here. I have three kids. They live here with me in Croatia, and I'm also running the company in the UK, and we have clients worldwide. So I'm kind of traveling all around very often. Well, not since COVID actually. Since COVID, everything is more or less digital, which is a welcome change for me at least. Um, so in terms of what we do with the all right, so my for my PhD, I did mostly political econ. So this is kind of, I was looking at the relationships between the corporate sector and politics and how it affects certain economic outcomes. For example, inequality. This was one of my issues, or specifically the distribution of incomes. This is something that I was particularly interested in, and I did a lot of papers and research on corruption, specifically local corruption, and also, as I already mentioned, the corporate relationships between and connections between top executives and politicians and how it affects their incomes. We can discuss that if you want. I'll be happy to, but that's going to take us at least another hour, I think.
Yeah, that sounds like a really dark rabbit hole to go down.
It
We
is.
might
It's
all get
very.
jaded
I
if we
agree.
go down that rabbit hole too long.
I agree. I agree. So yeah, in addition to that, so Oracle, I was saying, right. So with
Yes.
Oracle, what we do is, so we kind of designed this new. When I say we, it's me and two other co-founders. One is a physicist, and another is a computer scientist. And we had this idea. We wrote a paper together, or actually, we wanted to publish it, but then we wrote it, and we designed this new methodology combining wisdom of crowds with a kind of social network analysis, right? Analysis of
Mhm.
networks and clustered groups within networks. And so we found out that when you apply this type of methodology to standard like political polling questions, you can get much better responses, and you can get a much more accurate prediction of what's going to happen. So we were testing this first on student test scores, and we found incredible results. And then we started testing it on elections, right?
Mhm.
Our big breaks came with predicting Brexit and Trump back in
Mhm.
2016. With
Mhm.
incredible accuracy, with less than 1%, 1 percentage point accuracy. We then did again elections in France for Macron,
Mhm.
and the last one was the Biden-Trump election, where again we correctly predicted Biden across all the key swing states. And this gave us a lot of attention, so we started doing a lot of other jobs related to data science and polling and research, basically.
Mhm.
But now what we're doing is, lately, we're trying to see whether this methodology applies to predicting short-term market movements or short-term market sentiment, at least, right?
Mhm.
So we're trying to use this idea of pushing that sort of. Just to explain to you a little bit about the methodology. So the key is to combine the wisdom of crowds concept, where I ask you, so for example, what you think is going to happen and what your friends think is going to happen. So let's use
Mhm.
elections, right? So if I
Yes.
ask you guys who's going to win in your state, right, California or New York, well, that's pretty obvious. So
I'm
we're
in
focusing
Michigan, so a
more on
bit more of
swing
a swing
states.
state, actually.
Michigan, even better, right? We got Michigan, I think, within a single percentage point last time, a margin of error for the Biden election. So we ask you, so who's going to win and who you think is going to win, right? Based on your surroundings, and who do your friends and family who do they think is going to win, right? So you're basically, when I ask you about this type of question, I'm not just asking you who you're going to vote for, I'm asking you about your entire community. So I get a kind of a broader perspective into what you do. So this is the wisdom of crowds element, right? This has been used before, but to this we add the social network element, where I look at, so we used to do this on Facebook, and now we added Twitter as well. So we try to get pockets of your friends around you, so as to form clusters, and this way I can see whether or not you guys are, for example, in a cluster, in a bubble, right, in a typical biased cluster, which tells me that if you so it tells me whether or not you are in a community that's more or less biased to one end. So, for example, you can have all of your friends around you be Democrats or Republicans, and then you're kind of biased in your own separate way. What I'm looking for are people in between these groups, right? So someone who has a lot of friends who are Democrats, a lot of Republicans, a lot of independents, and that means that this person has a better probability of being right. It doesn't necessarily have to be right, but it has a greater probability. So that's the idea. And then we kind of take all of these probability distribution functions of each person, and we try to find the middle ground, and that's the prediction, right? Now this worked incredible with elections, and surprisingly well, right? I mean, no single person ever gets the prediction right, but when you aggregate it across the group, when you correct for the group bias, then you get a really accurate prediction. So now we're trying to see, does the same thing work with markets? Kind of pitching bulls and bears against each other every week and trying to see if this works. And so far last year we did 22 weeks, out of which 19 weeks we got it right. An average return, you wouldn't even believe it, it's over 100%.
Wow.
So we actually took physical money, $10,000, and started investing it.
So what are you measuring in particular, like investors' views on a particular stock, or investors' views on the market overall, or what in particular? Like, would you have an example or a hypothetical example you can kind of walk us through?
Sure. So the competition is still running. We're going to do it. We're going to test it for the entire year, 2022. It's been a turbulent year to start with, and as you might have noticed. But it's working fine, I think. We'll see. But so what we're asking them, we're changing it often, but in what's always consistent is the predictions for the S&P 500, Dow Jones, Bitcoin, the 10-year yield. We introduced the VIX index, and we're doing Apple and Tesla.
Okay.
Right. So only 2 stocks, right? And from all of these, we're only focusing our predictions for the S&P 500, because these have shown to be the most precise, like within 2% margin of error each week. So what we do essentially, when we get the target prediction for the week, we buy an iron condor option strategy, right? So where our confidence intervals are the upper and lower boundary of the iron condor, and then if our prediction finishes within these 2%, we make money, right? If it falls out, then we lose money. That's it. This way we have skin in the game for our own predictions, essentially. That's
Iron condor, if people don't know, is like a call or it's like an option spread trade where you're collecting premium if the market goes one direction, and if it goes beyond, like way beyond, then you're still protected to some degree, right, for tail risk, right?
Yeah, but it's kind of the opposite. So it has to finish within our confidence intervals in order for us to make money. If it falls outside, then our prediction is wrong.
You lose money, but only to a certain amount, because there's tail risk spreads on top, right? That's the
exactly.
So what time frame? Like when you ask people, like, are you saying, like, do you think the S&P 500 will go up next week or next year or tomorrow? What
so it's weekly.
Weekly,
right? We do it every Tuesday. It's open every Tuesday from 8 a.m. For 24 hours in standard Eastern time, and it closes 8 a.m. next morning on Wednesday. And then we make the prediction immediately on Wednesday. We send it over to all the participants. So far it's completely free for everyone, because we want to encourage more people to come in every week. And then we make the prediction for the end of trading on Friday. And that's
what's your latest? I mean, today is another rough day with the
It is. I'm just,
What do you think your prediction is for the next week, if you had to guess, or you're not allowed to reveal it?
yeah, it's public, right? So for this week, we predicted that it's gonna be lower than the Tuesday value. I think it was 4,400 was our S&P prediction. It's a little bit below that, but I think it's still in the confidence intervals, so that's good.
Okay.
So if it I think if it falls another like half a percentage point, I think we're gonna fall outside the weekly predictions this week, but I hope not.
Okay. All
So
right.
we'll see.
And so you don't know next week until Tuesday, is what you're
Yeah,
saying?
yeah. So we're doing it. So exactly. So it's every week is its own specific thing, right? So that's why I wanna have enough weeks to have to offer plenty of data, enough data for validation of the methodology, right? So
Interesting.
last year was 22 weeks. This year it's going to be 50 weeks. So I want to have a big enough of a lot of
Wow.
data in order to see if it works.
Has it been pretty accurate with Tesla? The stock, I mean, a lot of our followers are huge Tesla fans, and has it
I
been pretty
noticed that,
accurate
yeah.
week to week with Tesla?
Yeah, so Tesla has been, so we noticed that the more volatility, the less precision, right? So with Bitcoin and Tesla, it's been less precise than, for example, for Apple or the Dow or the
Yeah.
S&P. But yeah, so that's why we're only kind of investing for the S&P and a little bit for Apple. And I don't want to go into all the other predictions until we kind of get more volume in terms of participants that are engaged.
Yeah.
Yeah. I was going to say, I'd imagine there could be a decent amount of sample bias. So, for example, if you sent out this survey to all of our followers, probably every week, 80% of them would think Tesla's going to be green this week, and so that could really color your results. So, how do you kind of curate those results to make sure you're getting a representative sample of people who are kind of informed but also balanced in different viewpoints?
That's where the methodology that we use really comes to play, right? So whenever we did, for example, election predictions, it was always because I was always sending it to my friends, right? Initially, so when we did Brexit and we did Trump, it was always filled with Democrat leaning people, right? So it was always I had like 70% of Democrats, 30% of Republicans, so it was clearly unrepresentative, right? But it didn't matter because we asked people what your community thinks, what your people around you, what your followers think, what your friends think, right? So then when you're making a prediction, you're basically taking into account at least your entire community of how they feel. And we noticed this when we asked specific types of questions. It's a little bit convoluted, but we make it it's deliberate because we ask people, so what you think is going to happen, or what you think your friends think, and then this is a type of question that requires a cognitive activity, right? So and we measure time. We have timestamps of people filling out, so we see if someone is just scrolling through the survey and clicking. That doesn't really help, right? So this person is going to get a lower weight, and someone who really puts a thought into it, spends a minute or 2 minutes or half a minute on answering the question, really puts their thought into it, and kind of delivers at least a more accurate prediction. So yeah, to answer your question, so if we get a biased group, right, the methodology works in a way that I want to reduce their bias because I can see that they are clearly in a group of other individuals that are feeling the same way. So if I'm going to send it to your guys, and yeah, I will notice from their network, I'll notice that they're biased on Tesla, and I'll downgrade their prediction on Tesla because of it.
Yeah. Now, what do you I mean, while we're still talking about Tesla, what do you personally think about Tesla? I mean, do you have any personal views on it? Have you studied it? I'm just curious if you have a personal bias. Yeah, everyone has a bias one way or another. What's your bias towards Tesla?
No, I hold it, right? I went in at 440, so I'm still holding.
Okay. Okay.
Nice.
That's good. Yeah.
All right.
I had, let me tell you about an episode. So I had luck. I was lucky with when it was announced that it was joining the S&P 500, right?
Yeah.
I immediately bought Tesla calls, made a lot of money there. That was really
good.
Yeah.
Good for you.
Because you're thinking a lot of institutional investors are not going to buy it because it's going to be included in the S&P 500.
Yeah.
We both did the same thing, actually. So you're in good company there.
Yeah, we all think alike. I guess we're all kind of in the same tunnel or bubble, maybe. I don't know.
Could be. Maybe it's a good bubble. There are good bubbles and bad bubbles.
Yeah, although today it's not a good bubble. This week it's not a good bubble to be in, but overall it's been a good bubble.
No, I agree. I agree.
So how do we connect this back to the macro markets? I mean, Rich, we wanted to talk to you mostly about, I guess, the macro markets, and you had a great thread on interest rates versus inflation versus supply chain and inventory disruptions from COVID, and I think Matt and I largely agreed with it, and we've seen Kathy Wood talk about that in the past. And you see a few people talking about that. It seems like that narrative is catching on more and more. Even I think the Fed had some language, more stronger language around it earlier today. I saw in Bloomberg News or whatever. So it seems like the narrative of just the supply chain inventory disruptions of COVID creating the imbalance in the economy for, ingredients to inflation is sort of, people are starting to come around to that. I mean, is that sort of your view, I guess? Is that where, how did you come to that view, or how strongly do you feel about that for inflation, and that it'll kind of smooth out over time?
No, I definitely agree. I mean, what my perspective was, I was reading a lot of these, well, even people and economists and whatever, talking about the unprecedented expansion of the Fed's balance sheet and all that. And that's, it is a fact, it is true. But I was wondering, because I started following all these crises ever since the last one, the in 2008, and wrote papers about it. I was kind of academically invested in those during that time. And I noticed that the same thing is happening now, right? So after COVID, you have the same level of monetary expansion. You have the same, the currency in circulation is expanding. The Fed's balance sheet is expanding. Money supply M1, M2 is expanding. And back then you didn't have inflation. Today you do have inflation. So obviously there's it kind of questioned the monetary nature of this inflation. So then I was looking at the data, noticing that a lot of this money is still on bank reserves. Right, meaning that if you see the Fed's balance sheets, the M0, so this is kind of this is money, this is reserve money and money in circulation. A lot of, and you compare it to the bank reserve numbers, you can see that these curves are almost identical, right? So a lot of this money that was created by the Fed never even left the banks, right? It's circulating between the Fed and the banks in a bunch of repo and reverse repo operations. On the other hand, you have something called the velocity of money indicator, which is basically nominal GDP divided by money supply. And this indicator is down at its very, very historical low. So it's rock bottom, basically, if you look at the graph. What this means, what velocity measures money in circulation. So usually when the economy is expanding, you have more money circulating in the economy. So people spend more money, therefore more money is supposed to circulate in the economy. But now, ever since this huge monetary expansion, it's rock bottom, suggesting that a lot of this created money is not actually in the real economy, right? So people are not spending it. There is an increased number of money in circulation, but more of this money is in circulation because of the Biden and Trump stimulus packages than the money that's being pushed out by banks for credit expansion, for example. So all of these indicators pointed out that the inflation that we're seeing right now does not have a purely monetary origin, as many inflation episodes in the past did. For example, the 1970s or the 1920s in the United States, or in Europe as well. But it has something else, and the main difference between now and 2008 is COVID, right, or the post-COVID surge in demand, essentially. When you look at it, I mean, everyone's talking about supply shortages, right? Labor shortages, the supply chain issue, and some people are trying to downgrade it, saying that there was this shock of supply chain issues, but then it's still the Fed's problem to deal with. It is essentially, but the crucial point here is that the inflation that we have today, the 7.5% inflation that we saw, the CPI number, most of it is driven by higher energy prices, right? If you look at it, so oil prices, gasoline, natural gas, petrol, and electricity, right? And then you have things like food and other products, and most of this is the cause of this are supply chain disruptions, right? Look at oil, for example, right? You remember that oil, when COVID started in April, it turned negative at one point because of that future contract that expired on summer, right? I think it finished the week at $18. It's now over $90, so that's a 450% increase, which is enormous. But everyone, when you talk to people about oil, we're kind of used to this volatility in oil prices, because we understand, all right, why does oil go up? Usually artificial limitations of supply. So there's a trade war or something, or there's an upsurge in demand or something like that. The same thing happened to all other commodities, right? Or other agricultural products, where everything is typically used in production, was during COVID kind of constrained. There was no production moving in a lot of these segments, and there was the trade flows from Asia to the West essentially stopped during the lockdown. So the companies, the firms in the West, in the United States, and Europe, they essentially had to rely on their inventories to produce stuff because people were still buying stuff, right? We needed food, we needed other stuff. Maybe not as much as before, but still, food production at least was still riding high. So as the companies were spending on inventories, and as they couldn't rely on trade flows from Asia, they started shifting their suppliers from Asia to more kind of close to domestic, even to domestic markets or countries close to domestic markets. So in the United States, they were shifting a lot of this. Exactly, it's called nearshoring or what's the other term? Home shoring or something like that, right?
Yeah, they're just trying to be more local with the supply chain. Yeah.
Exactly. So for example, in the United States, a lot of that switched to Mexico, or even back home in Europe, is from like a lot of German German companies started switching their Asian suppliers for Turkey, for example, or Eastern European countries, and obviously these new suppliers couldn't cope with the huge demand. And this is well explained by one of Taleb's analogies, where you have, if you sell 50 stuff in one year and 50 stuff in another, it's not the same if you sell 0 here and 100 here, right? There's convexity, meaning that demand is huge. The same thing, I use the restaurant example, right? If 100 people walk into a restaurant all at once, and if they walk in throughout the day, there's going to be a huge difference, right? In the first case, a lot of people don't get their meal. And that's the same thing would happen with a lot of commodities, and especially energy, fuel and electricity and that sort of stuff. And this is what we're seeing in the price differentials that we're observing today. So the key drivers of inflation were essentially the supply chain issues, exacerbated by COVID, post-COVID, huge surge of post-COVID demand.
And then it seems like there's also like an element of the consumer or the companies buying the supplies, almost anticipating this and kind of hoarding some of the supplies, making it even worse, like with the chips and the cars and stuff. Maybe there's suspicion that there's some hoarding going on, and that's making it even worse, the chip supply shortage. So I don't know if that plays a big role or not, but it seems to exacerbate it in certain areas.
Definitely. I mean, the chip shortage example is a great one to explain the spike in used car prices, for example, right? So if you look at the car supply chain, what it takes to build a typical car, you have to outsource parts from all over the world, right? So even if you're a US car company and you have your suppliers that are domestic, all these suppliers are going to get their stuff from a bunch of countries around the world. So for example, the chip things, the computer chips, because you can't make a car today without a computer chip, a lot of them are being produced in China and Taiwan. Right, and so if there's a shortage of silicon, for example, necessary to produce these chips, they're not being supplied to a bigger enough capacity to all these suppliers, and they can give it to the cars, and the car production cycle gets slowed down. So if, for example, if one part is late for a few weeks, then the whole production of the car gets kind of backtracked for a few months even, right? And this explains, so there's if people are still buying they're demanding essentially new cars, but there's no new cars being pushed out in the market, or there's less new cars being pushed out in the market, then you have the standard a supply chain bottleneck. So you have less supply, huge demand, prices have to go up, right? So people are buying, bidding up the prices of used cars, essentially. So used cars prices are going up. It's like that for almost every commodity you can think of. The supply chain, the semiconductor shortage that you mentioned is a great example. And you also said hoarding, right? And this is also something that happened. So the big companies like Apple, like Microsoft, etc., they know that they have to produce their stuff. They need the chips, so they're going to be the first ones to give a higher price for that chip to come to them instead of some other companies, so that everyone else in the chain basically gets downgraded essentially and not get their stuff on time.
Yeah, so I'm going through a bit of a construction project in my house right now, and it's kind of hilarious the extent to which these supply chain issues are apparent just with products you wouldn't even think about. So, for example, we were just trying to order some blinds that had a little motor in them, and they're saying, oh, that's going to be more than 12 months because of the chip shortage. I'm like, for blinds? Like, the chip shortage is affecting blinds? Exactly. But like, even ordering windows and lumber, and like the contractor we're working with is basically saying he's never seen anything like this for all sorts of commodities that you don't really hear about in the news so much. And so then thinking about, if you're a purchasing manager at any company in any industry, and you're used to, say 2-month lead time to get a product from Asia, and then all of a sudden it's, 6-8 months, something like that. how you can't possibly be as accurate in kind of ordering the amount of goods that you need each month when you've got that much inventory in transit. And so when you think about the kind of multiplication of how much inventory is in transit right now across the global supply chain compared to normal levels, um, is your sense that there's potentially too much ordering going on by some of these purchasing managers, would of course lead to some inflation? And then if that's the case, how does that unwind? I mean, do you just have some sort of big buildup later on this year that creates some deflationary pressure, or is there something else that another way that this could pan out?
Yeah, definitely. Essentially, I think that there is going to be a deflationary pressure because of the huge growth in inventories, and this is what all these companies are doing right now. Exactly what you described, and if you look at the trend in inventory increases is up significantly, and this is supposed to ease these pressures on inflation from now on. At least, I mean, we're hoping. No one can really predict when this exactly will happen, but there are signs that this is already. This is why I kind of titled the whole blog on inflation that I was writing, "Is inflation peaking?" I think it is. Essentially, I think that this 7 to 8% inflation is basically going to be the peak inflation that we have right now because of all the things that we saw in the past. One indicator that's essentially pointing, that's really a strong predictor of these trends, is the BDI index. This is called the Baltic Dry Index, which is something that's measuring the demand for shipping worldwide. So typically, this is correlated a lot with. So it's a really good forward-looking indicator, like a leading indicator, because so when it goes up, essentially it means that there's a lot of demand for shipping, meaning that there's a lot of stuff being exported throughout the world, which is always good. So global trade increases, economic growth, etc. But what we had recently, so last year into 2021, BDI reached unprecedentedly high levels. The index itself is usually around 1,000, and now I think last year it was over 5,000, right?
Wow.
And now it's back to about 1,500. So it kind of went down really far ever since. I think it reached a peak in October, and then started going down ever since November, December, and I think by now, by February, it's about 1,500 points.
So the higher it is, what does that mean? The higher it is
higher,
correlates to more shipping around the world or
yeah,
less?
more boats floating around, essentially.
Okay.
That's what, so greater demand for shipping. So at that point in time, in October and November, you had that situation. If you remember, those 70 huge
All the
ships in front of the
ports.
LA
Yeah.
harbor, for example,
Yeah.
right? Because I read somewhere that about 70% of U.S. import goes through two harbors, through LA and New York.
Yeah.
Right? So, and if these are clustered, and you can imagine how all these goods are not basically arriving on time anywhere, because the ships are waiting, the goods are getting back, the harbors are at full capacity, etc. So what happened with the BDI index? So I was reading about it back then, and the explanation was, so as the index started falling down, meaning that shipbuilders started building more ships to accompany this demand, and when there's a marginal increase of ships with respect to the cargo that you have, the index goes down, right? This means that there's either a little bit less cargo and a little bit more ships, which means that this cargo is going to get to where it needs to go on time. But then the huge decline in BDI simply means that it's no longer 70 boats in front of LA Harbor. There's there's a normalization at least in these movements. So, and we're supposed to see this in the next 3 to 6 months time. We're supposed to see this easing throughout the rest of the economy, right? So transportation is still affected. I think the harbor is a little bit less, but transport still is. So again, it takes time for this to kind of translate itself down the line.
Yeah, I think an interesting corollary to that is if you look at the historical container freight indexes. I mean, the normal level kind of pre-COVID was like roughly $1,000 for a shipping container, but that it went up by an order of magnitude. I mean, it peaked in September at over $10,000 per container, and it's kind of come down since then. But it seems reasonable to presume that the supply of shipping containers is somewhat inelastic. And so if you have a huge increase in demand just because your supply chains have been so stretched out, this convexity that we talked about, the only thing that can really adjust in that equation is to increase shipping rates. And so then you've got that kind of increase in price pressure being spread across all the goods that are being shipped, and that would create the kind of extreme inflation that we're seeing right now. At least it would contribute to it. So it seems natural. Like you can't have sustained shipping container rates, like $10,000, because either more supply will be built or the demand will kind of naturally come down. So that's just kind of one area that supports what you're saying. But I don't hear many other economists or people talking about this.
I know it is a shame. I agree. I mean, like, because it's kind of more obvious to point out that the Fed is doing something wrong. People are more focused on rate hikes and quantitative easing and then tapering than these issues. But I think these issues point out to the problem much more precisely than just looking at the monetary indicators. Because I am a kind of a macroeconomist by vocation, but I always like to look at the microeconomic detail, kind of moving from the ground up to see how things are moving on the ground, and then to see how this affects. So from an individual company to the whole ecosystem, I think it gives you a much better and broader perspective into the whole macro environment.
Yeah, I want to come back to something you said earlier on too that I also haven't heard many people talk about, and that was the velocity of money. So obviously the thing on everyone's mind right now is M2 money supply. You kind of mentioned how it was kind of similar to what we saw in '08, and I think many people don't see that. They see this kind of huge hockey stick curve and they say, oh, this is unprecedented. What are the kind of echoes from 2008 that you see in the current data, and then what do you how do you explain the kind of decrease in velocity of money, and is there a risk that increases over time and that creates inflationary pressure?
Mm-hmm. Sure. So in terms of just to come back on the hockey stick curves, right? So there's two things that people are using. They're using the M1 curve, which kind of has a normal trend, and then it goes up all of a sudden. And this huge increase happened in 1 month, and it happened from April to May in 2020, so 2 years ago. And this was a result of a methodological change. So this wasn't money printing, right? So if you look at the M1, there was a methodological change from April to May, where the Fed started including savings deposit from M2 to M1, right? This is important because it shows you why M1 went from 4 billion in April to I think 17 billion in May. So it didn't, the Fed didn't print all this money in 1 month. It simply, switched savings deposit from one indicator to the other. Even though in M2 you also had this increase, but that increase, when you look at it, the changes in M0, so that's base money, and the changes in M1 and M2, they were essentially not that different from what happened in 2008. Right, in terms of the size, the mere size of this increase of the expansion of the Fed's balance sheet. So back then, you didn't have an inflationary pressure, and you didn't have it because demand was sluggish, right? You had huge unemployment, people not being able to find work for a while, and this is typically a typical consequence of financial crisis. Whenever you have a financial crisis, it's always much worse than a typical aggregate demand shock crisis, which is what COVID essentially was. So COVID was a typical aggregate demand shock. It happened. It was a huge strain on demand at one point, but then the economies bounced back really quickly. But when you have a financial crisis, this lasts much longer. Remember, in Europe, for example, we had a very prolonged recession that affected countries like due to the sovereign debt crisis of Greece and Italy and Spain, etc. The U.S. rebounded a little bit quicker, but essentially this recovery was always going to be much longer than your typical crisis, right? So that's why back then you didn't have this huge surge in demand in 2021, which we saw last year. So you couldn't have an inflationary pressure as much as we had now, right? So that's one end. On the other end, that's why I'm looking purely at the supply chain, because that was the main difference between now and back then, right? So back then there was no problems with the trade flows. Yeah. Trade dropped, volumes of trade dropped 20% during the last crisis, but they rebounded relatively steadily throughout the years. So you had a kind of a gradual recovery and countries easing into this, which is why the huge monetary expansion did not cause havoc, basically. Today it did, simply because there's a completely different context. You had another question. I forgot. You mentioned something.
It was on the velocity of money and
right,
kind of,
velocity.
Is there inflation risk as that potentially rises to more normal levels?
Yeah. So velocity is also, as I mentioned, the definition of velocity is nominal GDP divided by money supply, right? So as there's the denominator goes up, obviously velocity goes down. This is what happened. But you have to think about velocity in terms of I always look at it in correlation with the unemployment data, or specifically the employment to population ratio, which I think is a much better indicator of a labor market situation. Because unemployment, if you know how it's measured as the number of people looking for a job, right? Which, some people may not be looking for a job, so they get out of the labor force, but they're still working or not working, essentially, and you're not counting them towards the unemployment numbers. But with the employment population, you have a really, really good indication of the labor market strength. Now, this relationship historically, before 2008, it was very tightly correlated, right? So the velocity was correlated with employment population ratio, simply because more people having jobs, meaning more people spending and more money circulating in the economy. Whenever there's a recession, velocity and employment will usually go down, and that's the relationship, right? Ever since 2008, they kind of went into separate paths, right? Just specifically because of this, because of QE, essentially, right? Fed creating all this money in the economy between them and the banks kind of ruined that relationship between the velocity of money and employment population ratio. So it's no longer a good indicator of kind of future potential inflation pressures, right? So I think it's better in that perspective to look at currency in circulation, right? So if you look at currency in circulation, it doubled since 2008 until 2020, and then it again went up. It went up less, actually, from 2020 until today than it went over the past 10 years. And again, this money in circulation back then did not have the same inflationary pressure as it is having now, right? Again, there has to be another indicator. So we're looking to the velocity of money. I like to look at it specifically as an indicator that tells you that something is wrong, essentially. But in this perspective, I think that, like, focusing simply on the money circulating in the economy, it gives you a better idea of whether or not we're going to have this huge inflationary pressure. And I don't see it in the data.
So you
sorry,
go
Matt,
ahead,
go
Emmet.
on. You go.
Yeah, so that's really helpful. Thanks for that really unique perspective. I really wish we'd be hearing more of this kind of detailed analytics, as opposed to just kind of money supply,
Right.
fear mongering that seems to be out there more. One of the other threads you posted
I like
recently.
I like to read footnotes and of reports. That's kind of my thing,
Yeah, I think you have a longer attention span than the average
Yeah.
person now who's
Could be,
participating
could
in
be.
Twitter or TikTok.
That's how I got my PhD, So
Yeah.
huge attention span.
But you posted another thread a while ago, kind of looking at interest rates and the potential for an inverted yield curve potentially even down the road, and just the risk that would pose, obviously, to tech stocks in particular. Can you maybe walk through where we are today and kind of what risk do you see on the potential for the yield curve flattening out a bit from more normal levels and where it is right now?
Sure. So yeah, that thread was kind of explaining to people why the correction has started in January, and why tech stocks specifically were vulnerable to this idea of rising rates. And there's like a standard textbook explanation for this, right? As soon as the Fed rises rates, they raise the federal funds rates, which is the short-term rates that affect banks specifically. So whenever the Fed increases interest rates, it affects banks, and the banks increase your credit card rates. These are very tightly correlated, so the credit card rates and mortgage rates, for example, right? We're already seeing this, essentially. So this is markets. So the Fed still hasn't done anything, right? So we have to keep this in mind. The Fed is still pumping money with QE, and the Fed is still keeping interest rates very low. So it still hasn't done a single thing, but the markets are adapting, right? They're using this this time, looking into the Fed meetings and anticipating, already basically pricing in the rate increases that's going to happen in March. I mean, most definitely, we can probably say most definitely it's going to happen in March, whether 25 basis points or 50 basis points, we don't know. But essentially, as the market is pricing this in, tech stock valuations are going down, specifically because tech stock valuations, because of the way they're being made, are very sensitive to the interest rate increase. They're sensitive to something called the discount factor, right? So tech stock valuations are using, so people, valuating tech stocks are using the discounted cash flow model. So this is like a fancy way of saying investors are anticipating what the future cash flow of a tech company is going to be, and they're anticipating very high cash flows, specifically for up and coming tech companies, and they're saying, and the discount factor is essentially the interest rate, and as the discount factor was very low throughout the past year and a half, obviously these valuations are high, but as the discount factor increases, this kind of lowers the expected cash flow of a tech company, and consequently lowers its valuation, right?
Yep.
So I also want, sorry, I forgot to explain, right? The essential idea behind higher interest rates affecting your mortgages and affecting your credit card spending means that consumers are going to spend less. As consumers spend less, obviously, companies earn less, and this affects their earnings, and hence stock prices adapt. So this is how it works for every company. So that's why, always Fed interest rate increases have this sort of a way of kind of easing out the economic cycle. Usually the Fed increases interest rates, we're in a boom cycle, trying to kind of, engineer a soft landing of the economy. But historically, whenever the Fed started increasing interest rates, it led to essentially a recession down the line because of the yield curve. And now we arrive to the yield curve situation. And that's very important because the yield curve is being used as sort of a predictor of, as a kind of the best essentially predictor of recessions. Why? Because a yield curve, so how should we kind of unpack this? So let's talk about how it looks like, right? So what is a yield curve essentially? So yield curve is so it's the same. So the bonds of the same credit rating across different maturities, right? So for specifically when we say yield curve, we always mean the Treasury yield curve, right? Because it's a sort of a benchmark for government debt. And so you're looking at different interest rates or different yields, right, for different maturities. So you have 1 month, 3 month, 6 month, 1 year, 2 year, 5 year, 10 year, 20 year, 30 year, right? And then you draw a line. Typically, a normal yield curve is upward sloping, right? Meaning that you're going to have lower interest rates in the near term and higher yields in the long term, which makes sense, right? If you're borrowing money to Uncle Sam, to the government, if you're borrowing them on a 30-year period, you're expecting a higher return, so it's a higher risk, right? So if you're giving someone your money for 30 years, you're expecting at least 2-3% on that earnings or return on that investment. And if you're borrowing it for 1 month or 3 months, you're expecting much lower rates. So this is how it works in normal times and during economic expansions, right? And then when the yield curve starts inverting, this is when the Fed starts raising short-term interest rates. So the expected federal fund rate increases that we're talking about now.
Yeah.
So meaning that short-term rates start going up and long-term rates start going down. So the curve looking like this starts to flatten and it starts to look like this, right? So investors, this is basically a flat yield curve is always a sign of uncertainty, right? Because investors are not sure, which maturity level to pick. So it's basically all rates are around the same level. And then as something weird happens when long-term interest rates so long-term yields on 30-year or 20-year bonds start going down and short-term ones start going up because of the Fed increasing short-term rates, then the yield curve becomes inverted. And this
Now,
itself,
real quick, is it always the case that the long-term rates go down, or can they sometimes just stay where they are, but the short-term rates just keep going up?
yeah, exactly. They can also stay they are, but typically they kind of adjust a little bit downward. This has already started to happen, right?
Okay.
I've been watching it, like I kind of been plotting it ever since like in January. And if you look at it, the long-term rates have a tendency of slightly going down. So they went down for I think like 2.56% down to 2%. So it's kind of
Oh, wow.
that's a small
Okay.
decline. And this is and the reason why this is happening is because so it's kind of it's all due to expectations, right? Let's try to explain it simply, right? So when the Fed starts increasing short-term interest rates, investors are now anticipating a future recession, right? So they start buying more long-term bonds, okay, bonds with longer-term maturities, and this starts decreasing their yields, right? Because there's an inverted relationship. Exactly. And there's an inverted relationship between price and a price of a bond and yield of a bond, right? As yields go up, prices go down, and vice versa. And this kind of it becomes a self-reinforcing mechanism, right? So as the Fed starts increasing these short rates, starts doing pressure on this side of the curve, right? And investors start doing pressure on this part of the curve, it starts to invert and it sends a signal, all right, a recession is imminent. And when the yield curve inverts, usually recessions rise in about 6 to 9 months. That's typically, like, historically has been the case. So what and now a lot of people are looking at this, signaling this inversion. So if you look at the shape of the yield curve, it's still sloping upwards, just because the Fed still hasn't raised the short-term interest rates. I mean, these short-term interest rates, they're not really subject that much to expectations of market participants, because they're completely controlled by the Fed, right? So as the Fed increases their federal funds rate, the short-term rates go up, right? If the Fed moves it to 1% by the end of the year or 2% by the end of the year, you're going to see them at 2%. And when you have short-term rates at 2%, long-term rates falling below 2%, then you have the inverted yield curve. So a lot of people are predicting that we're going to see this inversion by the end of 2022, depending on how many rate hikes the Fed does. And when this happens, we can definitely then expect a recession by the end of 2023 or by mid to end 2023. And if you look at the future markets for the dollar futures, they're I think they're pricing in a recession sometime early 2024 or late 2023. I mean, it's very weird, right? I mean, so when we think about it this way, markets can be very, unstable and irrational. Obviously, expectations. If you look at expectations 3 months ago, they were not even close to this, right? But a lot of things change. Fed is coming out with a lot of different signals, so it's anticipating expectations throughout the yield curve and throughout the next few years. Whether or not this happens, obviously, you never know. It depends a lot of inflation numbers. So if my hypothesis is true, what we discussed today about inflation peaking and easing, I think that Fed is going to have a window of not being necessary to raise these rates so much in order to cause an inversion in the yield curve. Right? Whether or not this happens, we'll see. It's a very tricky situation. I think Fed it's not in a lose-lose situation, but it's in a very tight situation. Right?
Yeah.
I don't think it has like a first best solution. I think it's only like second or third best solutions right now.
Yeah.
In terms of
they're walking a fine line between recession and inflation, it seems like.
Yeah. Because if they hike too much, then you're risking a recession. If you're risking a recession, then investors are already pricing in rates going down by the end of 2023, and so you're going to again have this super cycle happening.
And a recession technically isn't that just 2 consecutive quarters of decline in GDP, right?
Yeah.
So we might even be in the start of a recession right now, but we might not even know it until the end of the second quarter, like first quarter and the second quarter both. So it's hard to really know. Like, the recession is kind of a weird technical. It's like almost like backward looking. Once you discover you're in a recession, it's sort of backward looking in my view. It's kind of strange, but
it is. Remember 2008, like when the panic started. It was September, right? When Lehman crashed and everything, and then all of a sudden we hear from MBR, the official kind of business cycle tracking institution. They're saying, we've already been in a recession since 2007. Well, fine, we only realized it right now, but the panic started in September 2008.
Yeah. So it's possible we're in a recession right now, and or maybe just one quarter. I mean, I think there was a recent estimate that the Atlanta Fed just said they think that GDP might only grow 0.1% for the first quarter, which is like on the borderline of a negative GDP. So it's possible we're in one starting this quarter, but maybe it's just a one quarter thing and it's not technically a recession. Who knows? We'll find out in time, I guess. And
no, that's interesting. But you know why? Because I think I read this. I can't remember where, but I read it. It was about. I think they were discussing about the effect of Omicron on the first quarter, because a lot of people in January weren't working because they were homesick due to COVID. So it's like Omicron is a kind of a lesser. It's a lesser COVID, so it's not that deadly. But it's still a lot of people were at home, in isolation, so they couldn't come to work. So you had economic activity slowing down, and I saw this with my clients as well, right? A lot less orders, a lot less business done in January. I mean, we didn't do any business in January, I think.
We
just started
very
doing
slow
it
month for a lot of people. Yeah, I think you're right. Yeah.
So it will probably affect the first quarter. Surely.
One more thing about the macro economy I wanted to pick your brain on is, I guess, the Russian-Ukraine tensions. That seems to be, even though the inflation and interest rates are really what's driving the macro market to a large degree, over the several month period we're seeing, in the last week or two, the Russia-Ukraine tensions have gotten all the headlines, in the financial media, and saying, oh, Russia's imminently going to attack, and then you see the S&P 500 drop 1 or 2% real fast, and like kind of, you just see it kind of creating serious waves in the macro markets. do you have any thoughts or opinions on this Ukrainian-Russian tensions and kind of the chess
Mm.
game being played between Putin and the rest of the world on this in Ukraine?
Listen, geopolitics always affects markets, obviously, but I have no idea how, right?
Yeah.
It's really hard to tell, and it's almost impossible to trade based on like geopolitical risks. I think like essentially what I want to believe is that there's not going to be a war, hopefully. Again, it's impossible to know what the Russians want or predict, but I think like I'm reading some of like analysis on this, some foreign policy analysis are saying that Russia is just simply not strong enough to pull off. Maybe to attack Ukraine, yes, but not like to cause an all-out war against the NATO. So it's in essence, I think this is going to be one of those events that could potentially be harmful, but won't. Just like the Evergrande debt crisis in China. Remember that was
Yeah.
a
Yeah.
big issue back in October. It didn't materialize, thankfully. Or if you remember, it was a funny one, the Suez Canal boat blockage.
Oh
I remember
yeah.
that was back in March, I think, right? Yeah, people
Yes.
were saying, this is going to cause a huge supply chain disruption. Maybe it did,
Yeah.
but,
Yeah.
but
Yeah.
it wasn't. I remember I was in the news and people asked me, like, is this going to, cause havoc to the fragile recovery? And I said, I don't think so. I think the recovery is going to be robust. This is just one little boat stuck. They're going to move it next week, and then we're going to be fine. So obviously the war situation is much more serious than that, but I hope that it's not going to be. It could be a potentially harmful event, but I hope it won't materialize.
So getting back to interest rates for just a second. Obviously, Bullard's been creating some waves this week, calling for 100 basis points of rate hikes between now and the summer. What's your sense on kind of how fast we will see some rate hikes, and then ultimately in the next 12 to 24 months in the say medium term, where do you think rates will kind of stabilize from here? Since I mean the market's clearly pricing in a decent amount of rate hikes already. Do you think it's about right, or do you think that it'll be different one way or another?
I think like Bullard has his worldview is let's do it strong now so that we don't have to do it later again, right? So we don't have to
Mhm.
kill off the recovery down the line. It does make a little bit of sense. I've heard a couple of economists advocating that approach, that we should hike strongly now, so as not having to repeat this over and over throughout the year. So yeah, if it does, might as well get it over with right now, do the correction right now in March, and then let's kind of start the recovery from there on. I'm not, again, as we already mentioned, I'm not sure. The Fed is walking a thin line, right? It's very difficult. I wouldn't be in the skin of the Fed governor right now. It's a very difficult position to be in, the Fed chair. But yeah, so let's say if it does happen, I think the market is not, it's pricing in, I think, a 50 basis points hike at this point in March,
Yeah.
right? If some Bullard is obviously pulling to one end, so it's going to be a compromise, so it's probably going to be around 50. And if this is priced in, we're not going to see that much volatility afterwards. So what's happening now in January and February, it's volatility driven by uncertainty, right? So the market still it's unsure what the Fed will do, how will it react. As soon as it does make a reaction, this uncertainty is probably gonna ease out. The Russia-Ukraine situation is not helping, obviously, with the uncertainty. It's increasing it, amplifying it. But again, these things should even out, and volatility should go down after the meeting, hopefully, right? But again, if the Fed does nothing, if it keeps it at zero, then we can probably anticipate more uncertainty as well, right? Because
Now,
then
what do you think your economist friends think are going to happen?
Ooh, that's excellent question. So
Getting
my
meta on us.
economist friends, I would say, just based on like my gut feeling, is that a lot of them are expecting like a small 25 basis point rise, 25 to 50 basis point rise.
Okay.
I think it's going to be around that. I would bet on 50 basis points.
Okay.
So yeah, I'm kind of curious, if I'm trying to wrap all these different threads that we've spoken about today together. If I can maybe try to put some words in your mouth and you tell me where I'm off.
Sure.
One of the other things that in one of your tweets that you posted was kind of the historic correlation between actual Fed interest rate rises and equity returns. And based on kind of the pure capital asset pricing model theory that you were talking about earlier, you would think that the Fed raising interest rates would actually result in stock underperformance over the long term. But the historical data doesn't support that. And what we've seen already in this market is that the equities have kind of front run fears of rising interest rates by the kind of sharp correction that we've seen in the stock market, especially in the tech sector. So if that's true, and the market is projecting a probability of a recession in 23 or 24, it seems to me that stitching all those different data points together, and the supply chain concerns, that you would think that there's some breathing room for equities, or potential that they could have a strong couple of years, given the fact that they've already come down so much, and that supply chain current concerns will be easing, but maybe that you'd be kind of watching the yield curve to see if it does invert, then maybe there's some more downside risk from where we are right now. Is that kind of a fair assessment, or what would you say differently?
I think it's a very fair assessment. That's exactly what I think. So yeah, I'm looking at, again, a lot of it depends on the Fed, right? And whatever they do in March and in other meetings. And as we said, right, if they do the rate hike, which has already been priced in, it's supposed to lower volatility, which is going to send markets on a rebound. There's also a lot of, and I've been watching this, a lot of dark pool activity out there, which also is kind of something that helps. It suggests that there's been a lot of dip buying in the option markets, which is supposed to send at one point the S&P upwards when this uncertainty kind of levels down or decreases. Again, this is contingent on there not being a war in Eastern Europe, which they hopefully won't. But yeah, definitely, as the Fed does this, we're going to watch the yield curve, watch for the inversion, and if the inversion happens, when it happens, then we should price in we should think about an upcoming recession. In terms of like the portfolio adjustments, what's already happening right now is a lot of investors are kind of shifting from tech to like energy because of inflation. Obviously, banks as well. Banks always benefit when interest rate hikes are up, and industrials. I would also say, keep a sort of start doing, if you haven't already, like tail hedging, some form of tail hedging. I like specifically what Spitznagel and Taleb are doing. Like when you have that little, I don't know if you read their books or
Yeah.
yeah. So when
fans,
you have Safe Havens and the other one, Tao of Capital, and obviously Taleb's fantastic books. So something like a small part of your portfolio that's supposed to be there in case there's a huge if a crisis happens. So again, when the inversion happens, it's always good to have this sort of tail risk protection, because we're not sure when exactly is it going to happen. So kind of rebalance the portfolio, keep the tail hedge protection, and it should be fine. Over the long run, we're fine, obviously, right? Over the long run, we're always good.
Yeah, we're fine. But the market can really get shocked very quickly, easily sometimes. Yeah.
Exactly. So you never know.
Yeah. So what particular instruments do you favor using, or use index options or interest rate futures or options? I mean, is there any particular instrument that you like to use for tail risk hedging? I'm just curious.
Yeah, SPY options, right? So ETF options on SPY. That's what I use specifically. Yeah.
That's pretty good.
Both I do some like leaps. I buy typically leaps for SPY. So leaps are long-term options for
Like deep out of the money puts or something.
Calls for like specifically calls for not for tail hedging, but like in general. And then for hedging as well, I do a 2 month out of the money put, like a small part of the, like 2% of the portfolio.
But deep out of the money in case there's a big shock, sort of,
exactly,
right?
Exactly.
So it's cheap. It's inexpensive.
So there's a convex payoff in that case.
Yeah.
Right.
Yeah. Great. Yeah, this has been a wonderful chat. I mean, one thing we wanted to bring in is, you're our first guest this calendar year, and this calendar year we're kind of instituting, implementing our funds business models to give half of the net fees to charity, and we have apportioned a certain amount of our fees that we've collected in 2021 to be able to give out, and we're giving out $2,500 to a charity of choice of each of our interviewees' choices when we bring them on this year. So I know we emailed you earlier, seeing if you could think of a charity or a couple charities, and we looked at them and they're all, legitimate to us. So is there a particular charity that of those that you'd like us to donate the $2,500 to?
Yeah, listen, first of all, I love the idea. It's wonderful. I love what you guys are doing. I think it's great, and you really kind of surprised me with that with the whole idea when you sent me that email. It really got me thinking and researching. I spent like yesterday like a few hours researching on which charities, because I don't know a lot about U.S. charities, and I was
Yeah.
thinking about, I went from like cancer to in general, to health, to like education, to children. It's been a ride, and I have to say I learned a lot about the charity market in the United
Oh,
States.
good.
You know, so yeah, I pinned down 3 of them. I think like the Scholarship America one is really cool, helping people like from underprivileged kids getting the scholarships, getting an education that they need. That's something that I always like to support. I personally like my entire Oxford education was paid through scholarships.
Wow.
So yeah, so I can, I relate to that.
Scholarshipamerica.org. That's the one. Yeah, that looks
Yeah,
interesting to
that
us.
was
Yeah.
exactly. And then it was another one, was it Save the Children, right? Or what was the no, what was the other one? The one for the kids, I forgot.
Preventchildabuse.org.
Prevent child
Yeah.
abuse. Yeah, I mean, and that one, because I'm a parent. I'm a parent of 3, right? 3 kids, and this is an issue that I care, deeply about because of my kids, and seeing children suffering from abuse is something that's
Yes.
yeah, disturbing, personally disturbing to me. So I kind of want to help that specific in that specific area. So again, if I have to choose only one, I'll have to think about it. Do I have
We
to
can
make a
split it
decision
across
right
those
now?
No, we
two.
can
Why don't we
split it.
split
Yeah.
it? In this case,
Okay,
we'll split
let's
it
split it.
across 2. Half to
Let's
the
split it.
Prevent Child Abuse America and half to the
Yeah, scholarship. Yeah, let's do it.
scholarshipamerica.org. Yeah, I think those are both great causes. I mean, children
No,
certainly are innocent, innocence and children are almost
absolutely.
are synonyms, and they're just unfortunately um, get terrible consequences by, just chance of the birth
Mhm.
lottery in a lot of cases,
That's
so I
true.
think both of these causes are incredible to help that. Yeah.
Yeah. This is again.
And
I was trying to pick something that's like close to me personally. Obviously, there's a lot of I saw so many important issues. I didn't know even charities existed for a lot of these issues, right? Like from
Yeah.
ranging
Yeah.
from a lot of things. But you guys really got me thinking. So thank you for that. I really kind of enjoyed it.
well, I'm
Now have
actually really glad to hear that it got you thinking. I mean, part of the reason that
absolutely.
we wanted to have our guests dictate kind of where they want their portion of the funds to go is because we want to kind of open source this model and get more people kind of thinking about charitable giving in general. And I think you're obviously our first one, but I think over time Emmett and I will probably learn a lot about all these
Yeah.
different types of charities, and
Mhm.
hopefully get a little bit better educated ourselves on which ones we feel are making more of an impact. So as excited as we are to be able to give $2,500 on your behalf to those 2 charities, hopefully there's a multiplicative effect of more people kind of hearing about them and thinking about their own charitable giving as
Absolutely.
well.
Absolutely, and I think the variety, the more the variety of guests you're going to invite to your show, you're going to have a more bigger pool of these charities that we can you can help and donate, right? But you already do donate to. I saw like a portion of your investment profits to charity, right?
That's sort of this
Yes.
process. We wrote in our offer memorandum that half of our fees
Yeah.
that the fund collects, net of expenses, goes to charity. And so we were thinking about,
Awesome.
what charities are we going to pick, and then we said, well, we have this content we're building out. Let's let the people we interview for content help decide
Wow.
where we're going to send it. So
Awesome.
we set it at $2,500 per interviewee for this year because we've collected that amount of fees. We think based on the number of interviews we expect to have this year. But
Cool.
we might have some leftover at the end, or I might have to, throw in some of the money I have in the foundation to it if it's over. So it's not a big deal either way. But we might
Mhm.
end up raising it if we collect more. If our fund does well and collects more fees, we'd raise it
Of course.
to 5,000 or 10,000 or whatever eventually, maybe. So it's kind of an interesting business case. Yeah,
That's really cool. I mean, I really like it. I really like the idea.
yeah.
Awesome. Awesome.
Yeah, this has been a great chat. Now, real quick, I just want to end on a few quick like shotgun questions that quick answers and
Okay.
kind of fun. I was thinking of something to end on here. Now,
Okay.
in like 10 seconds or less, where do you think Tesla stock will be in 2030?
Oh, okay. 2000. Let's go. $2,000.
$2,000?
Yeah,
Okay.
yeah.
Okay. All right. That's fair. Now, what do
It's
you
just
think about?
this is pure gut feeling. So
Yeah,
there's
pure
no
gut
there's
feeling.
no
It's all about, yeah,
That's
evaluation.
fine.
Nothing.
Don't
Yeah, yeah.
overthink it.
Don't
No.
overthink it. What do you think if you had to pick one word to describe Elon Musk? What would it be?
Uh,
It's a hard one.
yeah. One word. Intelligent. I don't know. Eccentric.
Okay, all right,
Yeah.
that's fair.
Okay.
That's good. That's good. And do you think that he will succeed in colonizing Mars eventually with like a self-sustaining city? And if so, what decade would you expect that to happen?
I really hope he will. I really like that project, and but let's give him let's give him 2 more decades
2
to achieve
decades,
that
okay.
goal.
2
Yeah.
decades to get to Mars or to have the self-sustaining city?
Well, to get to Mars at least. Let's
Okay,
do
all
that
right.
first, and then
Yeah. Okay,
let's
all right, all
build
right.
on from there.
All right. And
But
one last,
I really like the idea. I'm really optimistic about it.
yeah, yeah. And one last question.
Sure.
Do you think the next presidential election in the United States will be will create civil unrest like we've never seen before?
No,
Okay.
I'm always
All right.
optimistic about that.
All right.
No.
Good. All right. Matt, you have any quick shotgun questions for him? I think that
No,
covers
I
what
didn't know
wrote
you were
down.
going to do that. If I would have known, I would have prepared
I just
one.
put it on the fly. I just
Random.
thought of them.
Awesome.
How about this? How many?
Yeah.
Where is the SPY? Let's say end of this year.
Okay, good one. I'm gonna go with a bullish one. 5,000.
5,000.
Okay, we'll put our
Okay.
iron condor around there.
Yeah.
Yeah.
No, don't do that. Don't do that. It's not financial advice.
Not investment advice, and obviously
Not
this is
investment
not from
advice.
your
Not at all.
methodology, which is a little bit more rigorous.
Okay.
But
Listen,
this has been a
typically when I'm also participating in my surveys, and I'm not that good, right? So other users are better than me. So
Yeah.
don't take my face value for it.
Okay. And one last one. Sorry. What are like 2 or 3 Twitter handles that you highly value following? I mean, Taleb probably, like Elon Musk maybe. I don't know. But outside Taleb and Musk, are there like 2 or 3 Twitter handles that for the as an economist like you are, like that you highly value reading the material they put out?
I just recently started following the guy Alf who does this macro analysis. I think that he's really interesting. He's really good. There's also the
how do
parody
you spell
account,
that?
ALF Alf.
ALF.
Oh,
He's
okay.
the macro guy. Let me just check it out. What's his name?
It's all right. We can look it up. ALF. Okay.
It's called Macro Alf, right?
Okay. Macro Alf. I got it. We'll put it
He's
on the
the
thing
author of the
later.
Macro Compass. It's his Substack blog. It's really good for like macroeconomic analysis. I think
Okay.
he was a former trader or something, something like that. Former head of a
Okay.
big portfolio. Anyway, so I started following him recently, and it's been really good. I mean, I'm following a lot of really good stuff on Twitter. I'm following you two guys as well. So there's a lot of really good I mean, Twitter really surprised me. I always expected Twitter to be like before. I'm on Twitter since 2011, and it used to be like a cornucopia of like nonsense, and everything, right?
Developed into
But
something different now. Yeah.
absolutely, it's more. It can be used really. A lot of people are saying Twitter can be used as a free university. I agree with this. Right? There's a lot of really good content out there, really interesting people that you've never heard of, and you can learn something from, and it's really good. So like just not the famous guys like Taleb or
Yeah.
Musk or whoever. And I also like I have to mention like Parik Patel, the parody account.
Oh gosh, he's hilarious.
Yeah, he's hilarious.
He says he's Chamath's dad. It cracks me up.
Yeah, I know. I actually I had a few Zooms with him. I know him personally. He's a really great guy, really fun guy.
That's funny.
Yeah.
That's funny.
Yeah, I
Great.
think you actually kind of fit into that that realm of very kind of valuable, Twitter accounts that most people
Well,
probably
thank you.
have never heard of. So yeah, I agree.
Yeah.
There's certainly a lot of nonsense out there on Twitter, and I've seen a fair amount of it. But if you can kind of curate your thread in a way where you're getting just really
Exactly.
intelligent people who are kind of sharing their bit of knowledge, it is a free university. Absolutely.
Absolutely. Just
So
Yeah.
filter through the BS, right, and just move towards the important stuff, the good stuff.
Yeah. 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 I think following as many viewpoints as possible is key, because like you said, with your own
Methodology.
process
Yeah.
of wisdom
Yeah.
of crowd, with your, you can't stay in your bubble. You got to really try to branch
Absolutely.
out and understand. Like for me, I try to understand what the socialists are thinking, like Robert Reich and so, those people, and I'm trying to follow some of those people. And it's hard to wrap my head. It's painful, but I try my best to empathize and just understand their viewpoints on things. And, people I just disagree with in general. And it just helps me in general have a better worldview when I can try to understand so many different viewpoints. It's easier said than done, though.
No, it is very helpful, and sometimes you can see that really intelligent, super intelligent people that are, if they're wrapped in their own bubbles, they can be great on one topic, but if they're wrapped in their own bubbles around like a political topic, it's really hard to get them to understand the other side, right? This is causing
Yeah.
a lot of problems in as you mentioned, civil unrest and that sort of thing. So it's the polarization of society, because people are kind of behaving in their own bubbles, and we can see this perfectly when we're doing these polls, these election polls. We're looking at this perfectly. These bubbles are amazing, right? You can
Yeah.
see such a huge divergence between people not completely not being able to understand each other, right?
Yeah.
We saw this most clearly with like Hillary and Trump voters. It was clear as sky, right? And then
Yeah.
anyone in between had a much better idea than anyone in the bubble. And that was
Interesting.
kind of
Yeah.
the cornerstone. Yeah.
Cool.
yeah, very true.
All right. Well, this has been a great chat, Vuk. Appreciate it. We'll put your contact information, your company's website in the description, and your Twitter handle and such. And
Cool,
yeah,
thank
maybe
you.
we'll come back on here again someday and talk again. And we'll just
That'd be
pick your
great.
brain
I really enjoyed it. I think it was yeah. You guys are running a great you're running a great fund, and you're running a great show.